Stop. $3.2 billion just evaporated from 4 major banks in 96 hours. Not paper losses. Actual margin calls are forcing liquidations at the worst possible prices. And here's what nobody's reporting. A fifth bank, one they're not naming publicly, just posted emergency collateral Thursday at 11 p.m. that suggests they're more exposed than all 4 combined. We're going to identify them in the next 8 minutes by clearing the data they thought was hidden. JP Morgan wired $1.4 billion on Tuesday morning, not to close positions. To avoid closing positions, that would send silver past $50 and trigger systematic liquidation across 3 other metals. HSBC posted $870 million Wednesday, using silver they don't legally own. Scotia Bank moved $640 million on Thursday. And Bank of America pledged $320 million in physical metal from custody accounts, violating agreements with clients who are about to find out their allocated silver was used as collateral for the bank's gambling losses. The lawsuits start in 3 weeks when the custody reports are published. But here's the immediate crisis. These banks are still net short 294 million ounces at an average entry of 28.60. Silver closed yesterday at 33.18. Every penny it rises cost them $13 million. And at 11:47 this morning, silver touched 33.94. In the next 21 minutes, I'll show you the leaked clearing firm document that reveals which bank is hours from forced liquidation, the specific ETF about to freeze redemptions because its custodian violated metal pledging rules, and why $35.18 is the algorithmic trigger point where JP Morgan's automated risk systems force liquidate their entire position regardless of human override attempts. But first, you need to see what happened at 11:42 p.m. Sunday night when a margin call hit that the bank's risk models said had 0.03% probability of occurring. JP Morgan's value at risk model broke on Sunday night. Not miscalculated, broke. Silver moved 318 in 47 minutes during Asian hours when liquidity evaporated. Their model calculated the maximum expected move at 270. When price blew through their VAR ceiling, the automated margin system triggered $1.4 billion in collateral demands before human traders even knew it was happening. The clearing broker's automated system doesn't negotiate. It demands collateral by market open, or it force liquidates. JP Morgan couldn't wire cash fast enough because the Federal Reserve's FedWire doesn't process on Sundays. They had one option: pledge physical silver from client custody accounts as emergency collateral. Here's what makes this potentially criminal. Those custody agreements explicitly prohibit encumbering client metal for proprietary trading losses. But wait, here's where it gets worse. The silver they pledged belongs to the iShares Silver Trust. That's SLV, the largest silver ETF in the world, holding 647 million ounces. JP Morgan custodies that metal. They don't own it. And when the custody reports publish on February 3rd showing that allocated ETF silver was temporarily pledged to cover JP Morgan as derivative losses, SLV shareholders are going to panic redeem. Even 5% redemptions means 32 million ounces of physical delivery demands hitting a market where JP Morgan is simultaneously trying to cover shorts and satisfy COMEX delivery obligations. 3 sources of buying pressure are hitting the same physical market at the same time. The price doesn't rise, it gaps, 33 to 40 overnight. Now here's the revelation nobody saw coming. Remember that 5th unnamed bank I mentioned? We can identify them through the clearinghouse data that was updated 3 hours ago. There are only 6 banks with clearing privileges for precious metals at COMEX. 4 are publicly named as exposed. 1 is JP Morgan, HSBC, Scotia Bank, and Bank of America. Hold on. Before I reveal the exact price level where automated liquidation becomes unavoidable, you need to understand what happens on Friday when options expire. And the numbers make it mathematically impossible for COMEX to deliver physical metal to everyone with legitimate claims. Friday, January 17th. Options. Expiration. Current open interest shows 62,000 call contracts between 32 and 35 strikes. Silver at 33.18 puts 54,000 contracts in the money. Each contract represents 5,000 ounces. That's 270 million ounces of potential delivery if holders don't roll to March. COMEX registered inventory sits at 41.2 million ounces. They need to deliver 6.5 times more silver than exists in their entire system. But here's the mechanism that makes this week different from every other week's expiration. Shanghai just announced that, effective January 20th, they're eliminating cash settlement options on all silver contracts. That's Tuesday, 3 days after COMEX options expire. The timing isn't coincidental. China is forcing COMEX's hand by removing the escape valve just as delivery pressure peaks. Industry sources report that 42% of in-the-money call holders are refusing COMEX brokers' offers to roll positions. They're demanding delivery. That's 113 million ounces against 41.2 million available. The math broke. The system broke. And here's the specific trade that proves someone knows this is about to explode. At 9:47 a.m. this morning, a single entity bought 11,000 March $40 call options for $3.2 million. That's a bet that silver rises $7 in 60 days. The buyer either knows something or just lit $3 million on fire. Floor traders say the order came through Goldman Sachs' proprietary desk. Goldman smells blood. They're positioning to profit from the very squeeze that's about to destroy their competitors. Now here's what nobody's telling you, and this is where timelines converge into a single point of maximum danger. We have options expiration demanding delivery Friday. COMEX delivery confirmations due Monday, January 20th. The same day, Shanghai eliminates cash settlement. The February delivery period starts January 31st. And SLV custody reports published February 3rd revealing JP Morgan's collateral violations. 4 separate pressure points in 17 days, all requiring physical silver that doesn't exist in available inventory. But here's the catalyst that accelerates everything. There's a clearinghouse most people have never heard of that's about to default. And when it does, contagion spreads to every silver derivative in existence. The London Precious Metals Clearing Limited. Remember that name. LPMCL clears approximately 70% of global precious metals derivatives. They're the central counterparty that guarantees trades between banks, and leaked documents from their risk committee meeting Wednesday night show they're $490 million short on required margin coverage for silver positions. They're supposed to maintain 300% margin coverage on cleared positions. They're at 194% as of Wednesday's close. By their own rules, they should have halted new clearing and forced position reductions 48 hours ago. They didn't, because forcing position reductions means member banks have to liquidate, which spikes prices, which creates more margin deficits, which creates a death spiral. LPMCL is trapped between following their rules and destroying the market. So they're breaking their rules and praying prices stabilize before someone notices. But here's the problem with that strategy. The Bank for International Settlements audits LPMCL quarterly. Next audit starts Monday, January 27th. That's 10 days from now. If LPMCL is still under-margined when BIS auditors arrive, the audit report forces immediate remediation or clearing suspension. And clearing suspension means every derivative contract cleared through LPMCL becomes suspect. Counterparty risk explodes. Credit default swaps on the member banks spike. And the forced liquidations LPMCL was trying to avoid by breaking their rules happen anyway, but now with even more leverage and less time to execute. This is the systemic risk HSBC's memo was referencing when they talked about contagion. It's not just silver prices. It's the central clearing system for precious metals derivatives potentially failing because member banks are so over-leveraged that normal margining rules would destroy them, and the BIS audit in 10 days makes this a hard deadline. Either silver prices miraculously fall back under $30 and margin requirements normalize, or LPMCL faces suspension, and the entire paper silver market seizes up. Now I'm about to show you the specific algorithmic trigger that removes human decision-making from this equation and forces liquidation regardless of what banks or regulators want to happen. $35.18, remember that number. That's the price level where JP Morgan's automated risk management system overrides human traders and force liquidates their entire silver short position. Here's how we know a former JP Morgan risk analyst, speaking anonymously on a metals trading forum yesterday, confirmed that JP Morgan's commodity desk operates under automated circuit breakers that trigger at pre-programmed price levels. For silver, the circuit breaker sits at 22% above their average short entry price. Their average entry is $28.92 based on quarterly derivatives disclosures. 22% above that is $35.18. When silver crosses $35.18, the algorithm doesn't ask permission. It doesn't wait for approval. It buys back the entire 147 million ounce short position at market, regardless of price impact. The algorithm's job isn't to get good prices. It's too close to risk before it becomes catastrophic. Here's why this matters right now. Silver touched $33.94 this morning. It's $1.24 from the trigger. At the current volatility, silver moves $1 to $2 per day. We could hit $35.18 as early as tomorrow if Asian markets gap higher overnight. And once JP Morgan's algorithm triggers, it creates a feedback loop. Their forced buying spikes prices. Higher prices trigger HSBC and Scotia Bank's circuit breakers. More forced buying, higher prices, more circuit breakers. Until every trapped short has been liquidated and silver is trading wherever the last desperate buy order could find a seller. That could be $42. That could be $58. The algorithm doesn't care about fair value. It cares about position closure. But wait, here's the twist nobody expected. What if some of these banks actually want this to happen? Not publicly, not in a way they'd ever admit, but strategically. Let me show you why JP Morgan might be deliberately letting this spiral out of control. JP Morgan holds 156 million ounces of physical silver through custody operations, storage fees, and proprietary holdings. They're short 147 million ounces on paper. They're net long 9 million ounces when you combine physical and paper. If they liquidate their paper shorts at massive losses, but silver reprices from $33 to $52 in the process, their physical holdings gain $2.9 billion in value. Subtract their $1.4 billion in paper losses, and they're net positive $1.5 billion. They lose on derivatives. They win enormous on physical. And they get to blame the losses on market manipulation by Chinese buyers or systematic risk beyond their control, while quietly collecting massive gains on the physical side. This is the conspiracy within the conspiracy. The margin calls and forced liquidations might not be desperate attempts to avoid losses. They might be controlled demolitions, where the banks engineer the squeeze themselves, take public losses on paper to maintain regulatory victim status, while their physical holdings multiply in value. Goldman's $3 million bet on $40 calls makes perfect sense in this framework. They're not betting on an external squeeze. They're betting on a coordinated squeeze engineered by the very banks claiming to be victims. It's the perfect crime. Lose on paper, win on physical, and blame the whole thing on market forces beyond anyone's control. Now, here's where all these threads converge into the timeline that determines whether this breaks Monday or spirals through February. We have 17 days until the February delivery period begins, 10 days until BIS audits LPMCL, 3 days until Shanghai eliminates cash settlement, 1 day until options expiration creates 113 million ounces of delivery demands, and potentially 1 trading session until silver hits 35.18 and triggers JP Morgan's forced liquidation algorithm. The cascading sequence looks like this. Options expire Friday, demanding delivery. COMEX brokers offer cash premiums to avoid delivery. Shanghai announcement on Monday eliminates the arbitrage that makes cash premiums attractive. Tuesday, delivery demanders refuse cash because Shanghai delivery is suddenly more valuable. On Wednesday, COMEX confirms delivery obligations that exceed registered inventory. Thursday, someone files a lawsuit claiming COMEX is operating a fractional reserve fraud. Friday, regulatory pressure forces COMEX to choose between invoking force majeure or admitting the system is broken. Silver gaps to 40 plus because forced buying overwhelms the available supply. But here's the honest risk assessment, because I need to acknowledge what breaks this thesis. 3 interventions prevent the squeeze from fully playing out. First, the Federal Reserve's emergency liquidity facility to LPMCL that lets them operate under margined until positions normalize. Moral hazard is infinite, but it's happened before. Second, the COMEX rule change allows mandatory cash settlement even when buyers demand delivery. Destroys exchange credibility but prevents immediate default. Third, China backs off the Shanghai delivery requirement announcement, giving COMEX breathing room to manage delivery demands over a longer time frame. Any of these could happen. But here's the key distinction. Even if the intervention prevents an immediate squeeze, it doesn't make the bank's positions profitable. They still lost $3.2 billion. They still violated custody agreements. They're still trapped in shorts that cost them money every day. Silver stays above 30. Intervention produces survival, not success. It kicks the can down the road while the fundamental problem, paper leverage exceeding physical availability, remains unresolved. Here's what to watch in the next 72 hours that confirms or denies whether this escalates to a squeeze or gets managed down. First, Friday's options expiration settlement. If delivery demands exceed 50% of in-the-money contracts, the squeeze is confirmed beyond doubt. Second, silver's closing price on Friday. Above 35 signals momentum into Monday that could trigger JP Morgan's algorithm. Third, any announcement from COMEX about margin increases or delivery rule modifications. That's a panic signal. Fourth, Shanghai's premium behavior through the weekend. If it widens beyond $6, it confirms that physical shortage is intensifying. The specific price targets based on forced buying requirements look like this. The first gap takes silver from 33 to 38. That's Shanghai premium convergence, where arbitrage traders can no longer profit from the spread. The second gap runs from 38 to 44. That's where industrial stockpiles and opportunistic holders from years ago start selling. The third gap hits when circuit breakers trigger forced short covering. 44 to 53. That's panic buying with no price discipline because the closing position becomes more important than cost. These aren't predictions. They're mathematical outcomes when required buying exceeds available supply. The timeline variable is the only question. Compressed into 2 weeks, prices gap violently. Stretched over 60 days, the rise could be more controlled. Either way, the destination is the same. 50 plus silver by March 1st. The only question is smooth climb or an explosive squeeze. For anyone holding physical silver, this validates everything. You're holding an asset banks just lost $3.2 billion trying to short. An asset where delivery demands exceed inventory by 3 to 1. An asset trading at $38 in Shanghai physical markets, while paper pretends it's worth $33. When paper converges to physical, your holdings revalue to scarcity pricing, G, not leverage pricing. If you're looking to add exposure, understand you're buying into the most volatile setup in precious metals since 1980. Prices could gap $10 overnight. Liquidity could vanish during fast markets. This isn't a position for leverage or scared money. But if you're capitalized appropriately with funds, you can lock up through volatility. The math is asymmetric. The downside to 28 if a deflationary shock hits. Upside to 50 plus when squeeze mechanics play out. That's 15% downside versus 51% upside. Risk reward that makes sense if you believe delivery demands are real and forced buying is inevitable. The next 14 days determine whether this becomes the biggest commodity story of the decade or gets memory hold as another close call. But here's what's different this time. We have specific dates where specific things must happen. Options, expiration Friday. The Shanghai announcement on Monday. COMEX delivery confirmations following week. BIS audits the week after. There's no ambiguity about the timeline. The pressure points are dated and documented. And each one requires outcomes that the current system cannot deliver without breaking something. This is where understanding the difference between paper claims and physical metal determines whether you profit from this crisis or watch from the sidelines. The banks made their bet. They're losing billions. The system that let them make that bet is breaking under the weight of reality. The question isn't whether paper reprices to physical. It's whether you're positioned when it happens or scrambling after prices already moved. So here's what you do with this information. If you believe the delivery demands are real, if you believe LPMCL is undermargined, if you believe JP Morgan's algorithm triggers at 35.18, if you believe Shanghai forces delivery Tuesday, then the positioning decision becomes obvious. You're either holding physical silver before Friday close, or you're chasing prices Monday morning after the gap. There's no middle ground when supply shortages meet forced liquidations. The repricing isn't gradual, it's violent. And the early movers capture the entire spread while late arrivals buy the top. I'm not telling you what to do with your money. I'm telling you what the banks are doing with billions of dollars right now. They're posting emergency collateral. They're pledging client silver illegally. They're begging the Fed for bailouts. They're liquidating other positions to cover silver losses. They're in full crisis mode. And they're the ones with billion-dollar risk management systems and direct access to regulatory decision makers. If they're panicking, you should be paying attention, because what comes next isn't theoretical anymore. It's documented, it's dated, and it starts in less than 72 hours. The only question is whether you're ready for it, or whether you'll spend February wondering why you saw it coming but didn't act. That decision is yours. The timeline is set. The consequences are coming. Choose accordingly.